Hi folks, how you doing today? Hope you're doing well. It's May 28th, 2020. Very sleepy day in the markets, and I'm going to talk to you about a few things regarding the psychology behind some of these price moves, and just in general, we'll talk a bit about the price action. So I didn't take any trades today. I guess I just didn't like anything that I saw, or I just wasn't able to understand the psychology of these price moves enough to be able to put on a trade. Okay, so we're going to talk about a few things here, and you can see that SPY was in a trading range for the majority part of the day, and we finally broke above this trading range, and we're starting to see a bit higher prices here. One thing I noticed right out of the gate was that the financial sector was extremely weak on a gap up open, and the Qs were extremely strong, and we moved up to test the highs of yesterday's move on the Qs, okay? Considering that would have been a good opportunity to develop a bias on either side of those trades, because there were two extremes in the market, and we're seeing this rotation coming back where one sector is weak, the other sector is strong. So you can see there's money being transferred around the markets. XLF on that massive gap up open, definitely some profit taking right off the open there. Key levels I was looking at on the Nasdaq were as follows. The lows of this session, which was right around there. The lows of last week's session, which was right around there. The lows of this 4-hour higher low. And that is pretty much it. Those are the important levels I was keeping an eye on, as well as the highs of yesterday. All right, guys, let's do a bit of price action analysis on the Nasdaq today. So very bullish off the open, and we moved up initially to test yesterday's highs, okay? So I want to talk to you about this because there's the institutional mindset that you need to understand as a trader, is that the majority of traders don't understand this, is that when they look at a chart, they're impulsively making decisions. They see something and they trade it, but that's the wrong way to approach it. In fact, you need to be able to see what is obvious and position yourself to likely trade against what is obvious. And that's harder than it seems, but that's the institutional mindset in simple terms of how to put it, right? So for example, we move up aggressively to test yesterday's highs. You could have initially put in limit orders to be selling near yesterday's highs, because that is the institutional mindset to be fading a move up or fading an extended move, right? If you faded that, you would have had a small window of profit to the moving average because there was continued momentum up to the upside, but you still would have had a scalp. For example, if you had a limit sell near the high of yesterday, you would have caught a bit of profit within these candles just for mini scalps here, okay? The momentum continued up and we broke above yesterday's high. But notice how when we broke above it, we didn't stay above it very long, okay? It faded pretty quickly. So you can say that big extended move like this, no follow through right away. You can look to fade that with a stop above 231, just fade it to the moving average. Now, when we get back to the moving average, you want to probably look to get on the right side of this trend because you can see the trend is up. So if we're holding above these highs here, the trend is your friend, so probably you want to stay long, right? Let's watch this pullback. So we had a two-legged pullback, 1, 2, right to the 26 period moving average. And now this is generally where you want to get long. You could have a stop underneath the lows or something. And keep an eye on, look at this candle right here, how it formed. You can see there's a lot of volume there. And we tested lower prices, and then the candle closed near its high. So that's a bullish reversal candlestick. Now, generally, there's two ways you can see that. You can see that there's bulls buying that. That's pretty obvious. And you can also see it that if there's no buyers coming in to push this price higher here, buyers are definitely going to get trapped if we see lower prices under 229.80-ish, okay? So you have to understand the both sides of that perspective. So what we saw was higher prices because there weren't enough sellers to keep this price contained under 230.41. We saw higher prices. Now, a huge push like this, a beginner trader will see that and they will say buy. But let me tell you why that's not what you want to do in this case. You don't want to buy when you see this because professional traders are selling into moves like this. They're not buying that. They're selling into that. They're taking profits. They were getting long down here. You can see how we broke higher 3 times. Look at that. So you could say once we made higher highs above the high. Twice we tried again on this candle. And then a third time we saw higher highs. So 3 higher highs with limited follow through. And then you could have faded it back to the moving average at that point with a stop above 232. Remember, 232 is key resistance. Fade back to the moving average. Now, when we're back to the moving average, you want to be watching the tape, see if the buyers are coming back around the 230.41. So there was continued buying here, and the trend is your friend. So we want to keep a long bias generally, right? If you're looking to fade against the trend, you have to be cautious, and it needs to be only for scalps. So you can see that we caught buyers around the moving average there, and then we slowly faded again. Now look how we broke the highs by a couple of pennies and then immediately faded back to the moving average. This is why you don't want to be buying breakouts on the Nasdaq, guys. Save your breakouts for penny stocks with tons of shorts getting squeezed out. Do not trade that way on the Nasdaq. You will lose money, okay? Because if you're buying calls up here and then you get through this pullback, you just lost, 10% of their value by buying them near the highs when you could have been setting a limit order to buy them down here. Anyhow, so you can see how we tested the 12 exponential twice there. You see 2 holds of the moving average. Decent area for a long. You can see that there's continued buying in this market. We see upside, but look at how the upside is moving. So we're seeing slow upside, a little bit at a time, a little bit of volume, shorts kind of getting squeezed, a bit of volume picking up there. And again, we're moving into this key resistance here, this 232. So you can see how we're seeing higher prices, but it's not necessarily squeeze price action, squeezometer style moves, right? We're moving up into a key resistance. We're seeing limited follow through to the upside. So generally, you can still be looking to fade these moves. So you can see again another higher high with no follow through coming right up to this 232 resistance. It's a decent setup for a fade right back to the moving average as being your target. Stops above 232. That would have worked pretty well here. You can see we faded with 3 candles down to the 12 exponential. If you're waiting for those patient fills, just trying to fade against the stretched move here into the resistance level, you would have caught some profit on this fade right here. And then at that point, you can either choose to keep your stop above there or just stop out at break even at that point. You took some profit from the market from fading the extended move, fading the breakouts essentially, and then just get out of the trade once it gets back at us. You would have probably got stopped out on that candle. But now look at how it reacts here. Again, we're right near the resistance. You can see how we pop up to test it and then a candle closing near its low. So the setup is still valid for fading that resistance at this point. You can see how we faded it right down to the 26 period. And then let's watch the consolidation here. And you can see we faded right down to approximately 231. So you had to be watching if there was going to be buyers around 231. Continued selling or not. So definitely this caught some bears involved here, because when you see a fade like that off a key area of resistance, the bears, like we were saying before, the bears are looking to sell the breaks below these lows, but you don't want to be looking to sell the breaks below these lows, guys, because at any moment you can see this kind of thing happen. Now bears get trapped. Now we see this big bull. When you see that, are you going to be buying? I would say no, personally. I would say you needed to be getting long down here, because you see a big bull like that, you're not going to be buying right at 231.50 where there was previous resistance on the way down. In fact, you should be fading that move. You see a big move like that, fade it, put a stop above the highs, and you would have got some profit. Today was a day for fading, guys. Now, when you see a bear break with no follow through like that, that's another signal to get long. See, bear break, lower wick, trap the bears out, no follow through. At that point, you can start selling the puts again and getting long, and just kind of, you could either scalp it or sell puts, keep a stop below these lows. And that's the general idea here. And you can watch how after that we managed to move higher and break out. So you didn't even need to get the breakout, but you just said when you see a lower low with no follow through like that, get on the long side of the trade, right? Anyhow, guys, that's just my price action analysis for today on the Nasdaq. Again, since the financial sector was relatively weak, you could have traded it bearish, you could have traded the Nasdaq bullish. And if you look at the S&Ps, you see we had a very relatively boring trading range to start here. And I said to myself, after 2 or 3 bearish days, so you can see to the 2 previous days here, I would say even the 3 previous days, or 4 previous days, in fact, 1 day, 2 days, 3 days, 4 days, that off the open, if you would have sold puts, you would have not made money because we sold off into the open. Today was a day to sell puts, but I wasn't confident at any point to sell puts. And that is what I'm trying to discover right now, guys, is that what's the psychological cause for the fact that I knew that today was a more likely chance of making money if you were to just sell a bunch of puts, but I wasn't able to sell them? Because I guess I didn't have the confirmation I was looking for from the market, right? But you can see that clearly when all sectors are not moving down at the same time, SPY will just kind of grind up with precedence to the Nasdaq, of course, because SPY is 30% technology. So if the Nasdaq's moving up, you want to be giving precedence to the SPY bulls, right? Anyhow, guys, so I'm exploring the psychological aspects about this market, the psychological price moves, about what drives these markets. Essentially, you got big bear, 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 and then everyone's looking bearish. I'm going to sell at the moving average. Nope. I'm going to sell at the moving average. Stop above the highs. Nope. Bull break, bull break, bull break. You know what I mean? And that's the whole thing. And then today, same deal. The bears are all trapped. We might get a little bear break. They're going to try to average down their positions, and then we just chop around. Anyhow, guys, I'm going on a bit of a tangent here. So I will see you in the next video. Take care. Bye.